So thank you so much for logging on and being here. Like I said, we are trying a new format where everyone can see everyone's faces. So we're just going to kind of play this out and see how it goes. I was super excited to see some faces that I haven't seen in a while. So you guys are just making my day by being here. So thank you so much. A couple things, just housekeeping. Please make sure if you have any background noise to mute yourself, because that's kind of the catch-22 of this format is we can't mute everyone. So we want to minimize any background noise. And number two, we'd really like to make it interactive. If you have questions, feel free to put it in the chat box. Colin will be watching that for us. So as we're going through, feel free to ask any questions. We're going to do our best to end between 10:40 and 10:45. We have a lot to catch up on today. So first, I'm really excited to ask Dan Peck to share what's going on in the mortgage world. We keep hearing about historically low interest rates. I feel like I've been saying that for quite a few years now, but I think it's very true in today's world. So Dan Peck, I know you're out there. If you would like to turn on your mic and share some information about what's going on in the mortgage world.
Gotcha. Can you hear me? Do you hear me okay, Shai?
Yes.
Yeah.
Okay, good. Well, thank you for having me. I mean, yeah, I can't even begin to explain what's gone on the last 120 days. I mean, a lot of people have probably been like, where are lenders at? What's going on? But, you know, just to give everybody kind of a quick synopsis of what's happened over the last 120 days since the middle of March, you know, essentially we saw more retraction in lending overnight than we saw all of 2008 to 2010, for those of you that were in the industry. Essentially overnight, we lost 35% of mortgage lending products the second COVID hit and the entire banking system and government realized there was going to be a massive issue. And so that's been a real big mess for lenders to clean up and try to figure out how to navigate. I do feel like we're coming out of it, but it's been a very interesting 120 days. I think there is finally some stability there. For those of you that do a lot of bigger transactions, you probably noticed the jumbo world is a lot different right now. Conforming is also a little bit different just because of all the new guidelines and everything that have been put into place. Agents that are trying to refinance that are self-employed, obviously, or 1099 commission, all of those guidelines have changed. The government's even changed their guidelines on people that are self-employed and or commission just because their income has been so impacted by what's gone on. And even though it was forced by the government, they still went in and changed guidelines. So it's definitely made things very interesting to navigate over the last few months. So everything's been, like I said, really interesting. I think the overall path that we're on is good. You know, rates are low. They finally have stabilized. All mortgages that are conforming have kind of come to a spot where we think that they're not going to really move much anymore. You know, there's two main types of mortgage products out there. You know, there's government loans and conventional. And in the conventional bucket, we have the regular conventional loans, but then also the high balance conventional mortgages, which are those loans that allow people to buy at higher price points and still get a good rate. We saw there to be disparity between those two products for about 60 days, but that's kind of calmed down as well. So really the customer should be able to go out and on anything under a loan amount of 741 in the Tri-County area, they should be able to get a rate that's under 3% on average. You know, unless their credit score has been banged up, they might get into the threes. But every regular conforming purchase transaction we're doing is 2.75 to 3%, depending on credit score and scenario. It's pretty incredible just to see what the payment does on something like that. Very often I think of Sol's Power of One illustration. You know, about a year ago, we were at 3.75 to, 4%, and we're a full percentage point below that now. And so, that essentially pushes purchasing power up about 10%, depending on what area you're in and what the taxes and insurance are. But it's one of the reasons why you guys have seen prices get pushed up so much. And we're routinely getting contracts where they start out at 400 or 420 and they quickly get escalated to 450 just because it's easier for people to get qualified now than it was 6-8 months ago, just because of rates. Other things going on stability wise is we don't anticipate rates going anywhere. I would, I'm not the expert, but based on everything that we hear and we're being told, is that the federal government's pretty much said they're going to keep rates low for a while. And that's going to be probably into 2021, maybe even farther, just depending on how ugly the economy gets beat up because of what's going on with all these countries, or all these local economies and local areas having to get shut down because of the virus. They want to keep rates low just because it enables everybody to refinance, get their house payment as low as possible. But then it also is a point of making the economy grow as much as possible with housing and all that stuff. And so I don't see rates going anywhere for a while. So I think you're going to be in this environment for a while. That being said, that's also a double-edged sword. I've personally heard of 2 local lenders that have discussed 100% cutting off even taking any more refinance applications because the system is so bogged down. We saw the writing on the wall 60 to 90 days ago. There is $13 trillion in mortgage debt that is eligible to be refinanced. Rates are lower than they've been since World War II. The entire lending system at capacity in the nation, with lenders all over, credit unions, banks, Caliber Home Loans, everybody has a capacity of about 4 to 6 trillion a year. And that's if they're killing themselves. So there's literally 2 years of pent up demand. We have appraisers right now where they're getting to the point where even if we order appraisals on a rush on a purchase, we are having struggles finding appraisers to do them in 2 or 3 weeks. So if you're in Eastern Washington, it can take 4 to 6 weeks just to get an appraisal. So we're starting to see the overall download and downward pressure on the industry in other areas of that we can't control, that are third-party vendors. They're just starting to get slower and slower and slower. Even escrows, we love escrow, they're great. They only have so much capacity as well. We're starting to see issues with them being able to get stuff done on time as well. So, I guess I just urge everyone to just have patience. There's going to be things that are out of everybody's control that we just don't know. And we don't see that issue getting better. We see it probably getting worse over the next 90 days because so many loans are hitting the system that the system just can't handle it. And so I would just urge everybody to make sure that they've do what they can to keep things in place. Our turn times on a refinance are anywhere from 20 to 30 days just for a loan approval. That's company-wide. A purchase transaction is 6 to 7 business days, and that's faster than most. I know that I've had agents in your office tell me that even if they have consumers not using Caliber, using other lenders, that they're a week from closing and they still don't have the appraisal in because they're just getting bogged down. So I guess the theme is on a purchase transaction, just making sure that you've got everything there and knowing that, most transactions are definitely taking a full 30 days, if not more, and that all of that 30 days is getting used. We routinely ask if we can get stuff done closed early, and that just doesn't seem to be something that is easily doable in the environment we're in. But overall, there's good stability. Rates are staying low. We're seeing the jumbo market come around. Jumbo rates have settled into the low to mid 3s. So they're 3.25 to 3.5. So obviously, given our sales prices, we do a lot of jumbo. All of the product that is under, depending on the price point, all the jumbo product under 20% down has, for lack of a better way of putting it, evaporated. It's just not there right now. All of the old school portfolio loans that we used to talk about, the loans where they had a bankruptcy a year or two ago, not only did Caliber, but pretty much every lender pulled all of their A- or B paper product off the market just because of the unknown of what the secondary market's going to look like for bonds going forward.
Dan, can I ask you a quick question?
You got it, bud. What's up?
So I know some buyers now, and even refinances, they're paying 1 to 1.5 points to even get their rate lower. Okay.
Yes, that is correct. Right now we're
Can you
seeing.
just explain to the agents why that's a good option for them to know about, because that might be something they want to be presenting to their clients as an option and choice. If it's
Correct. Yeah. So more often than not, we're having people pay points now more than ever. And the main reason is they feel that if they've on a refinance, if they're going to be in their home forever, they're like, hey, I'm not ever going to touch this loan ever again. So they're going in and they're structuring the refinance to get it to the best spot. There is a lot of diminishing returns on a refi, where you push the rate as low as possible before it gets really, really expensive. That rate's around 2.65 to 2.75. Anything below that, we can go all the way down to 2.25 on a 30-year fixed. It just begins to get exponentially more expensive. And if you understand how the yield curve works on interest rates, rates are so low that the lower rate doesn't necessarily pay off really quick. And so, we're trying to get people into that happy medium spot where they can buy the rate down if they want to, but it's not too expensive. On a purchase, it's the same thing. They're looking at it going, okay, I'm not going to want to touch this. If it's a move-up home, they're definitely looking at it more than not because they know it's a property they're probably going to live in long-term. We also have a program, even if they don't put 20% down, where we will waive the PMI after 12 months and 24 months, depending on the scenario. So the loan that we give them and that we service, they can go in and get the PMI waived if they have it after 24 months, if they've made all their payments and the value of the home is maintained or gone up. They can petition to get it removed. So that consumer's looking at it going, okay, I'm getting into the twos rate. Yes, I have PMI, but even if rates go up, I don't want to have to refinance out of this because the odds of rates being this low when I refinance are pretty slim. So they want a loan that they can just leave the rate alone and then they can waive the PMI. Did that answer your question, Sol? Thank you, Jerry.
Thanks, Dan.
Is there any other questions I can answer, guys? I mean, I guess the thing that I want everybody to know is I know that just me personally, it's guys, I've been doing loans for 23 years. The last 120 days has been the most challenging of my career. It's been the absolute hardest time frame that I've been in. We're all working from home. My entire team is, we're on Zoom calls every day. It's just the hardest environment we've been in, and we're trying to navigate that. Every lender's trying to navigate that. And so I think anybody that's a service provider to you guys, whether it's escrow, whether it's a lender, whether it's title, all of them are dealing with stuff right now that we've never dealt with. And it's a challenging environment. And we're also dealing with record volume that we can't contain. And what's interesting about right now is in 2008 to 2010, there was no purchase volume. There was none. I mean, there's very little. It was very low. I mean, Albie can recollect all those graphs and things where we had massive inventory and tons of short sales. And, I can go back and look at my pipelines and there was no purchase transactions. It was like 20% purchase, 80% refi. What's different about today is that there is still just as much purchase volume, if not more, than there was a year ago. But now everybody wants to refinance. And so it's a double-edged sword. So the system is double bogged down and it's going through something it's usually not going through. Usually when you have a time like now, one of the transactions goes away or dwindles. Purchases dwindle, so then the refinances pick up or vice versa. And we haven't been seeing that. And so that's where everybody's really struggling on the third-party vendor side, is that there's just as many purchases right now as there was a year ago, but yet now everybody and their brother wants to refinance their house. And so the system just is not set up to handle that nationwide.
Dan, I got a question. Hey, good to see you.
Yes,
good
sir.
to see everybody. How about FHA rates? Where are
That's
they?
a really good question. So actually great thing to bring up, Moshe. Government lending was loosening, if you guys remember. For those that have had FHA borrowers, we were starting to see 580 to 620 credit score open up. We were getting manually underwritten loans going. I mean, things were getting back to the way that they were. When I mentioned 5 minutes ago that overnight 35% of lending products went away, we lost all sub 620 credit score loans overnight on FHA and VA loans, as well as USDA. We've seen those come back a little bit. Where they've come back a little bit is they want compensating factors, lots of reserves. We get exceptions on them. They are still harder loans to do. So we're kind of back to that 620 credit score minimum that they want people to have on a government loan. The ones that I do get exceptions on, we are still able to maintain a 2.75 interest rate on them. I mean, government rates are around 2.75 to, if you've got somebody that's really, really aggressive on credit score and they want to pay a point, they might even be able to get down to 2.25. It just kind of depends on the scenario. But yeah, I mean, rates on government loans are easily in the twos. The issue is lenders right now do not want to stick a B paper product, which they would consider anything sub 620 score, in their portfolio, because in the past 12 months, when they started analyzing stuff, as credit had been loosened, the 580 to 619 credit score bucket and your 0 down loans did start having a tick up in payment default. So early payment default had a higher ratio. It wasn't very high, but it was more than normal. And so they just, again, not that those loans are bad, but the initial reaction was just to pull their arms back and say, we don't want to service these right now. And so we're seeing that come back. I would anticipate as we move forward and we get more of a normalized environment in the COVID environment that we're in, that you'll see those products come back. But nobody should be getting a loan on a government loan. I do know that some lenders are, I'm not going to name names, I do know that some lenders are still issuing sub 620 credit score on government loans. And then what they're doing is they're just telling the borrower that they're at 3.5 or 3.75%, and that's just the rate they're going to get. And they're just pushing that rate on the consumer just to build in a higher margin on the loan, so that if they do go into early payment defaults, you know, the odds are in their favor that you know, they'll do 10 loans that won't go into default, and they might do one that does, and the other 10 loans that they have all this extra margin on will compensate for that. Because the government when the government went into forbearance allowance on all these loans, they in the sidelines they created rules for lenders on early payment default. And early payment default is when a borrower goes into a mortgage and they don't make their first mortgage payment on some loans, or early payment default can be on the first 90 days of payments on other loans. And it was a big issue. In the month of March, we had 90 loans in our division. My division is California, Oregon, Washington, Idaho, Montana, Nevada, and Arizona. We had 90 loans in March that were purchase transactions that closed, and within a week of closing the purchase, the new purchaser called in and wanted to defer their payments.
Wow.
So who buys a house and then immediately wants to defer their payments, right? That's a huge issue when it comes to how loans are done. And so that's what caused a lot of the problems. And the government literally had to go in and fix it. I mean, they had to work with lenders, and the Fed did, and had to go in with FHA and conventional, Fannie and Freddie. And it took about 60 days to get all of that kind of worked out on how they were going to treat those early payment defaults, because the government pretty much came out and said, yeah, you have a mortgage, you can default on it and it won't hurt you. So anyways, those are the things that we've been working through the last quarter.
Dan,
Awesome.
one more question.
Hold on, Moshe. Moshe, I'm really sorry. I kind of have to keep things moving. So we have Dan's email, and if you want to put in the chat box, we can let Dan know what your questions are.
Yeah, Moshe, go in the chat box and I'll grab that really quick, okay?
Yeah. All right, Dan, thank you so much for the update. I really appreciate it. I think it's really important now more than ever to manage your clients' expectations for getting pre-approvals and refis. They need to know what to expect, that the turnaround times are a little bit slower than usual. So just make sure we're managing everyone's expectations with that. So moving along, next, Sol is going to give us his take on what is going on in the market and how much fun we've been having in real estate these days. So,
Hey everybody, hope everyone's doing well. Hey, you know, before I get started, because there's a lot of good stuff going on, but we need to take a little perspective. I think we all should just take a deep breath. You know, it's been an interesting 4 months, and I just want to kind of reflect a little bit because we started back in March, and first thing, you know, we start with this virus. Okay, everyone goes home, let's lock down the economy, close the restaurants, close the stores, go home, don't go to the office. for a few days there, would even do real estate. And so we had the virus going on. We had the economy shut down. The stock market went from 28,000 to 19,000 and unemployment through the roof and all this kind of stuff. You got to understand. Then we threw in, let's have a little bit of social unrest with the Floyd thing and some protesting and some looters who had their own agenda. And let's throw in an election. An election puts everything on steroids anyway when it comes to the news and all that. So you don't have a economical recession. You have a virus recession. You have a health recession. You have a virus federal economy. The virus and the feds are running this economy. Okay? So let's kind of get that in perspective. The feds, the Federal Reserve is printing money, which we'll talk about here in a little bit. $600 a week unemployment checks, PPP money, all these kind of things. So they're printing money, interest rates. It takes a crisis to get to low interest rates. We got 2.9% financing, or whatever you want to say. We got all this stuff going on. So what does all this mean? Well, Colin, can you put up that graph that I gave you? I'm just only going to put up one graph, and I'm going to talk for a few minutes. But this kind of is a point that I want to get to you guys, because there's a lot that this graph says. So if you see the listing pending at 3379, last week in the multiple, that's how many homes went pending. If you look at new listings that came in last week, 1635 in the multiple. So you can see we're over 2 to 1. I just want you to know that even at the trough, even at the worst part in March, during this virus, we always had more pendings than new listings. One more time, we always had more listings pending than new listings all through this period that we've gone through. You guys got to realize that, because there's some things I'm going to tell you now that are going to resonate right to this. So you guys kind of have that. The other thing I want you to look at is the third line down is listings price reduced, 675. Now that number was 300 to 400 a week in, let's say, March-ish, April-ish. It popped up because now people want to get their home sold. So sellers realize and good listing agents realize if there's no activity, we better get that price reduced because we want to get this thing done before the election. Okay? Okay, you can take that off if you want, Colin. So let's talk about what this all means, okay? First of all, you guys got to realize I have preliminary stats from July. We're in August, right? You're at the highest median price in King County ever. You're at the highest price King County ever. The infamous power of one, right? Highest median price used to be $726,000, $275,000 2 years ago. Now it's $727,500. You got that part? You're almost 1,000 over, right? What the median price used to be. Pierce County's at record high. King County's at record high. So if you look at last July, the median price was $680. So you went from $680 to $727 in a year, median price, single family homes, King County. You went up almost $48,000. That's $4,000 a month. People can't save that quickly. You can't, when you stop prices went up 5%, 8%, get rid of the percent. Talk about how much dollars you've gone up in a year. All you got to do is get the breakouts out of the multiple listing service. It'll back this all up, which John L. Scott just released them yesterday. So you got all these stats. The other thing you got to realize, July of 2020 had more sales in 1 month than any month since June of 2017. 3 years. Hope you're getting all this. So who is buying home during a pandemic? We got a worldwide pandemic. We got a virus. Da 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 da. You know, I call it the shock and awe period. 9/11. We all knew where we were when the planes hit the building on 9/11. The shock and awe for the virus was March, April. Everybody go home. The people were dying up in the old folks home in Kirkland, all that kind of stuff. But now we kind of know what the virus is. We know the virus pretty much hits people with pre-existing conditions, older, that kind of things. We know who are vulnerable. We know it's contagious as hell. So I was talking to Tom Ferry over the weekend. The week before, he had a birthday party for his wife, And so he thought he'd be clever and do an outdoor social distancing party. He had 16 people there, 16 people, 60% got COVID. So 9 or 10 people got COVID out of those 16. Now they're all fine, right? But we just had some friends of ours, our age, their kids and grandkids flew up from out of state, came in, stayed a week. Now, one of our friends has COVID, the other one does not. So what does that mean, have COVID? Well, she has a temperature of about 100 degrees and she feels weak, but she's getting stronger, okay? We know it's very, very contagious. We know what we have to do to be smart. I'm not gonna go through all that stuff, but you have to understand, we know what it is now. So people are kind of going on with their lives and we forget we live in one of the strongest economies in the country. You live in one of the strongest economy of the country where people are confident about their jobs. They want these 2.9% interest rates. 35% of your buyers are first-time buyers. So 35% are first-time buyers. So even though you had 8,800 sales in July, think how many multiple offers didn't go through. Think how many multiple offers didn't go through. So you had way more than 10,000 sales. You just had only 8,900 that came together, right? These are single family. This is now the 8,800 number I'm giving you is 4 counties, single family and condos, 4 counties. That's Pierce County, Snohomish, Kitsap, and King. But it kind of gives you an idea of what's going on. So if, depending where your head's been, where people's heads been, you got to realize the market is alive and well. There's going to be listing shortage for months to come. There's going to be a listing shortage for months to come. So if you don't have a plan and program in place to take more and more listings, I'd be getting into place now. And if you don't have a plan in place to maximize each listing so you're taking more from that one listing launches and or whatever, I'd be doing that. So if I just look at Southeast King County, last year, they had 716 listings active in the multiple last July. 7/16/2019. This year we had 375. So you're almost half of last year. In other words, the demand is through the roof. The demand is through the roof. And you got to understand it's going to be that a while. We get lost in the news. You know, in other words, like I said, we're in a virus Federal Reserve economy, right? The feds are going to keep printing money. So what you got to understand, what's going to happen is right now, what they're talking about is a $600 a week unemployment money has expired. So now they're negotiating, the Democrats and Republicans, how much do we want to give this time around, right? Then the next week they'll probably figure that out because some of these people aren't getting any money right now, but they were getting a base of $2,400 a month, right? They were getting a base of $2,400 plus their regular unemployment, whatever that would have been. So some people are making 50 G's a year in the last few months, and now they're negotiating. So that's coming up. So the $600 a week may be negotiated back. And then the PPP money that has been given out to some of the agents got it now, companies have gotten it, that's running out. So you're going to start seeing layoffs, and you're going to start seeing other things as this PP money runs out, unemployment reduces, all kinds of things going on. But again, the industries that got hit the hardest, hotels, restaurants, all those kind of things, those are the ones that fill up the most. Now, we have been very fortunate. In my 45 plus years in real estate, most recessions, the real estate industry participates. We're not participating in this one, we're leading it out of it. Why? Because it's not an economy thing, it's a virus thing. So there's so many people here with jobs that feel good about their jobs. They want these low interest rates, they want to move out, they want a Zoom room now, they want room outside in the house, they want room inside. This year they got to homeschool. Now, some of you guys are homeschooling this year for the first time. I'm all about creative things where some people are hiring substitutes. Others are school sharing. In other words, parents can have it for 2 or 3 days and other parents can have it 2 or 3 days because they got a job sharing and school sharing. So it's getting very creative, but that means that our clients are going to be very, very busy, right? And I highly recommend everybody here, if you haven't taken a vacation, you guys should definitely plan a vacation before September to make sure you take advantage of the weather and what's going on out there. Because as we get towards November, don't forget daylight saving time kicks in. It's dark at 4 o'clock. We're not going to be outside as much. So you just want to make sure you're taking care of yourself first. So you have a few things to play out. You have the unemployment to play out. There'll be something there. You're in an election year, so Trump's going to keep this thing going as much as he can because he knows that's his only shot at being reelected. So the economy is going to keep going, you know, unless there's a curveball we can't see. But the Federal Reserve is always already committed to printing money, printing money, printing money. But here's what I'd be doing. You got to get a clear goal. There's only 90 days, like 12 weeks from today's the election, right? Today's August 3rd. I think it's November 3rd. What is your goals for the next 90 days? Between now and the election, I'd want clarity. What is my goal for the next 90 days? And I'm tripling down on my marketing, my calling, everything. I'm tripling down, right? I'm tripling down because there's so much movement. Now, you got to understand, when there's uncertainty in the market, in the world, the flight to quality is always high. So right now, a flight to quality agents is always the highest I've seen, right? Because there's too much uncertainty and noise. So let's talk about noise. If you turn on CNN, Fox, any of these stations, breaking news, crisis in America, stress, 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 stress. Turn off the news, but the thing, this is what your clients are hearing. There's so much noise out there. Most of them don't know we have low interest rates. Most of them don't know we have multiple offers. Most of them do not know they can get top dollar for their home. You have to be bolder and more often with your marketing than ever before because it's too much noise. Now you throw in an election, you got more noise. The election puts everything on steroids. The news, one party says this, the other party says that. So everyone gets lost in this whole real estate thing. Now there should be some good articles coming out after these because these stats will come out to the public in the next few days. You got to make sure that you're looking at those and what are you doing with these stats? Am I videoing them? Am I emailing them? Am I mailing them out? What are you doing? What's your marketing plan? If you know the next 90 days could be like gold for you, what are you doing to maximize the marketing you can tell to your database? See, I'd be calling everybody from A to Z. I can email them. I'm calling them. I want to hear their voice. There's 4 categories of your clients. One client's going to be like me. I'm staying here forever. I'm very happy, but I'm glad you called me to see how I'm doing, a wellness check. What are you doing for the summer? Hey, how has the virus affected you? So one way or the other, what are you doing for your summer plans? It's a wellness check, but also you're going to talk about refinancing. The other reason for my call, Shai, is to make sure you understand where rates have gone. We're at historic lows with like 2.9% financing, and some of my clients are saving $400 to $500 a month on their payment, which is $6,000 a year, $60,000 in 10 years. So I want to make sure, I don't know how long do you think you'll be staying in your home, because if you're going to be there long term, you need to look at it. You know, it's going to be also you getting an update on your database, what they're doing for housing. So some people are going to be like me. I'm staying here forever. I don't need to refi, but I appreciate the call. You're going to be high on my referral list if I think about anybody think buying or selling. Other people you call, they want to buy, they want to sell, they want to invest, or they're going to refer to you. And then you have a new bucket over here. This is the bucket that might be unemployed, might be on forbearance, and might have to list in the months ahead. They might not tell you that up front. They might be going through their own thing. They might be going through their own denial, and they have to go through their whole kind of fear cycle, fear, denial, until they get the acceptance. But thank God this time around, most people have equity, not like 2008, 9, and 10. But you have to be ahead of this. And I'm coming from a place of just wellness and service check and support, right? Talking about refinancing, this and that. It's all upside, and I'm going to be on top of it. So you have people like me. You have people who want to move up or down. You're also going to build a pipeline for 2021. They're going to say, you know, Sol, I'm not quite thinking this, but my wife and I are really thinking about next spring. I want to get ahead of them. I want to have an offense in place. You know, this is, you know, Shai's going to talk about this a little bit, the great divide, have and have-nots. I have never seen it jump this big so quick because people can't do open houses. The people with an organized database, addresses, phone numbers, emails, and are doing something with them on a consistent basis are taking it to the bank. And the ones who aren't doing much or haven't put it together are still thinking about it, they're drifting, okay? And this will keep happening. But I want a clear database and a clear plan and program with my database. I mean, buy-side, the John L. Scott buy-side program, there's been about 900 listings taken by John L. Scott agents with sellers who are in the buy-side program. Over 900. Now, I think almost 200 of those are Renton and Kent North. That's a no-brainer. Market updates, market ready. the program where basically John L. Scott gives them money to get the home fixed before that comes on the market if they don't have money for that. That's been gold. And some people it's a conversation starter for clients, whether they use it or don't use it. Some agents are getting them approved because they might need it for a work order they didn't realize. But these are all point of difference in value created. So there's all kinds of things going on out there, but I gotta get clear on what I want to do in the next 90 days. Because between now and the election, it's gold. It's go time, it's gold. First of all, you better take care of yourself. You better go on vacation if you haven't, because some of you guys are gonna be real busy if you're homeschooling and doing all that stuff too. But our clients are busy, right? Now there's gonna be a lot of people on vacation, but I'm calling everybody from A to Z. I'm doing market update videos. I'm taking these July stats and I'm taking them to the bank. Why? Because people who don't know people don't know what's going on in real estate. You know, it's like someone asking me, what's going on in farming, Sol? I don't have a clue. I don't care. But you are the voice. And people care about their house because that's where their values are. That's where they have their equities. That's where their home is. So when you have, you have the whole forbearance thing, that's going to last for a while. It might even get extended. Well, that means you have landlords now who are selling because they have tenants who are not paying. So now we're seeing more rentals, multifamily come on the market because you have some landlords and some smaller landlords have single family homes and they can't afford it. So they're coming on the market. But you got to mail like never before, call, text. You got to be the voice. You got to be the voice like never before. So real estate, like I said, in most economies, when there's a recession, real estate goes right down. Just like in 2008 through 12, you had over 50,000 homes on the market. Now I think we got about 10,000 or something like that. Okay, but you have more buyers than homes, and that's going to go on for a while. So I better have a clear listing program in place, and I need to have a clear database program in place. And if you have those systems in place, you're calling people A through Z, you're going to get referrals, you're going to get repeat business. They're going to be thanking you for helping me refi or letting me know. These market updates that we do, this is Southeast County update, housing updates. Either people get them who are in Southeast or East Side or Pierce County, there's like 8 of them or 12 of them. Now agents are getting leads off of this because their clients are seeing 2.87% interest rates and they never thought interest rates were that low. And the first few sentences tells them the market's hot. So agents are mailing this out, emailing this out, and doing them on video, right? You got to blitz everywhere. You know, it's like you got to come from all sides. I'm mailing, I'm texting, I'm emailing, I'm calling. I'm coming from all sides. I'm blitzing the next 90 days. And you got to have a clear 90-day goal and plan because this is an election year and the economy is going to stay strong a while. Now there's going to be layoffs, okay? Just know there's going to be layoffs. That's going to happen because it's already starting to happen. That's all that means is some people are going to have to sell, right? So we're in an industry where we're here to service. We're here to take care of people. We're here to help them with their housing goals and give them the choices and options and let them decide. But I want to make sure everyone on this call realizes, over 70 people on this call, you realize this is go time. And the market's hot. During that pandemic, during the virus, if people are lost in the news, your clients, they don't realize we have the highest prices ever. We have multiple offers going on, and you pretty much can do whatever you want to do. But you have people moving out of state. You have people moving to the suburbs. We're seeing a lot more Seattle condos come on the market here in the next 30 days. A lot going on. But we're positioned very well in the South King County market for what's going on because they all want to come to the burbs and they also want to come to affordability. So I just wanted to give you guys a quick update because this is our time to just get some clear goals, get some clear plans, and let's make the 90 days count. Back to you, Shai.
Awesome. Thank you so much, Sol. So Sol, we heard from Dan Peck about what's going on with mortgage rates right now. We're hearing from Sol what's going on in the market. And basically the possibilities are endless. So Sol kind of alluded to this idea of the Great Divide. And Lennox talks about that these days, that with what is changing in our industry, the have and the have-nots, that piece in the middle is growing larger and larger. So we're talking to a lot of brokers And a lot of them are having record years. I mean, who would have thought in the middle of a worldwide pandemic, people are going to sell record numbers of real estate? But we also have a group that are still thinking about the fact that they can't do open houses. And I get it. I get it. It's hard to pivot your business. It's hard to adjust. But if you choose not to make these adjustments, you're basically making the choice of what side of the Great Divide do you want to end up on. So Sol talked about the idea of calling your database with wellness checks. That is the easiest thing you can do. You can authentically call them and see how they're doing. You can get the message out about real estate. People are using social media. They're using videos. If you need ideas, if you want to either get your business back on track or take your business to the next level to make sure you end up on the right side of this Great Divide, we're still doing weekly accountability groups. Katie and I are doing an Albie one-on-one coaching via Zoom, phone calls anytime. So please just don't feel like if you are struggling or you need ideas or you really want to take your business to the next level, we have a lot of things in place to help you get to where you want to go. There's a lot of opportunity right now. You really just have to make that decision to jump on it. So we're going to be a few minutes behind schedule, but there's a few more things that I really need to go through. So first of all, we are seeing a new trend. We've had about 8 closings in the last 2 weeks that we're going to close on a Friday, and we did not get recording numbers. So we're talking to title companies. We're hearing that because county workers are furloughed and they might have a lighter staff, that this is becoming more and more of an issue. So a best practice to avoid this is to close on a Wednesday or Thursday. We do have confirmation from the John L. Scott attorney that as long as the title company is providing a gap coverage of the title insurance, that it's okay to release keys. Now, I don't like saying that because it goes against what we've all learned, but again, we are seeing this trend. So just be on the lookout for it and try to make closings on Wednesdays and Thursdays. We have a couple of exciting training opportunities coming up. John L. Scott, you guys know I've been with Albie and Sol for many years. I love Camus, but John L. Scott has knocked my socks off during COVID. They have really given us so many different ideas and platforms and concepts that we need to maneuver the business these days. And they just started a John L. Scott Buy, Sale, Safe certification. Basically, it's a new certification to show your clients that you can keep everyone safe to the best of your ability. One of the best parts about this class is it's 30 minutes. So y'all know I love that. We'll be sending out notices. The next class is tomorrow and then August 10th and 12th. So I recommend that you do that. And if you really want to take it to the next level, do a video about having the certification to show your clients how you're keeping them safe. It's important these days for people to know what to expect. September 1st through September 3rd is Tom Ferry's 17th annual summit. So we were planning on showing a video, but it's a little bit long, so we're going to send that out to you. But what's important about this year's summit is a few things. The keynote speaker is one of my favorites, Gary Vaynerchuk. He is fantastic. He is kind of a serial entrepreneur. It's going to talk a lot about marketing and mental toughness. Tom's theme this year for the summit is really mental toughness, offers accepted, more listings, building your brand, and controlling your time. So I'm super excited. There's 54 breakout sessions, and you basically have 2 ways to purchase the summit. For $99, it will just be a live feed that you watch September 1st through September 3rd. Or for $199, you can have an on-demand version where you can start and stop it and you get to save it forever. So these are some really great John L. Scott prices. We will send out some more information and a video after the meeting so you guys can sign up for the John L. Scott pricing. Last, regarding training, is we are working on bringing in Annie Fitzsimmons for a 3 clock-hour class. The plan will be to split it up into 2 90-minute sessions because, let's face it, no one wants to sit on a computer for 3 hours. But what I'd really like to do is invite you guys to email me any questions that you have for Annie, any concerns, challenges you're facing in the market. Because as you know, we will bring Annie in to really focus on what we need her to focus on. So please email me some questions that you would like Annie to address, and we will have the dates and times of that coming out in the next few weeks. 2 more things. John L. Scott has partnered up with Virtuance. Virtuance, as we know, is a photography company. They do amazing how they do their photo shoots. I'm not a photographer, but they do a great job. The bottom line is, if you sign up with Virtuance through John L. Scott, there's a pretty substantial savings. So 25 photos used to be $189. Well, now you can save $46. They will also go through and do Matterport at the same time. So Matterport prices are between $89 and $179, depending on the square footage. So we'll also send out the specifics on that as well, but just keep it in mind to save you some money. Last announcement is a little bittersweet for our John L. Scott family. Kaylee Sorensen at the front desk has decided to pursue another career opportunity. So Kaylee's been helping us for almost 3 years. She has been such a huge contributor to the office. She is flexible. People love her. She does such an amazing job. And so I wanted to let everyone know that we thank her for her time here. Her last day is going to be on Friday, so feel free to give her a call or an email or stop by and thank her for her time here. We wish her all the best, and I'm sure we'll still be seeing her around, but we want to wish her well with her new adventure. So that wraps up our meeting. I want to thank everyone so much for coming and participating. It is so great to see some faces we haven't got to see in a while. If you are interested in joining an accountability group, getting some coaching to take your business to the next level, reach out and we would love to help you. All right, well, that will be it. We'll be sending out some specifics on today's meeting. Thank you guys so much. Why don't we unmute and say goodbye?
Bye, everybody.
Bye.
Bye.
Bye. Good seeing everybody.
Kaylee.
Bye.
Bye.
Bye, everybody.
Thank you, guys.
Sol.
Congrats, Kaylee.
Congrats, Kaylee.
Bye, Shai.
Bye, everyone. Have a great week.
Bye, Shai.
Bye, Grace.
Bye.
I forgot that I'm the host.